know that feeling when everything aligns perfectly? You enter the trade and it immediately goes against you. Yeah, I know that feeling because it happened to me recently, and trust me, it sucks. But that got me thinking, I can't be the only one making this mistake, right? No, 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 there's a ton of traders that actually fall into this exact same trap every single day. So today I'm going to show you exactly how professional traders avoid this scenario and how they manage to see what most retail traders cannot, right? Let's discuss the obvious. Most retail traders are gamblers. Yeah, that's right, I said it. Look at these lower time frame charts right here. Price moves fast, candlesticks bounce everywhere, and you're constantly tempted to jump in and out for quick profits. Trading these lower time frames feels exciting because it gives you instant dopamine hits, potential fast profits, and that adrenaline rush. And look, I totally get it. It's fun when you're actually in profit and making money. But the reality is, it can be absolutely soul-crushing when your trade moves quickly against you, which happens far more often than most people like to admit. And if you're not careful, these small losses will add up to something way bigger. Just have a look how noisy and confusing this is. This is exactly why the lower time frames without context will make your head spin, mate. You're literally just guessing a teardrop in a massive river. And the real kick is, especially most beginner traders, they trade without the clarity of the higher time frame. And without it, you're pretty much just a feather in the wind. Because most retail traders don't have the big brother view. The bigger picture context is absolutely necessary to trade lower time frames successfully. So with this being said, you might be wondering whether the institutions actually trade the lower time frame. And the answer is, surprisingly, yes. But it's definitely not the way most retail traders are doing it. So let me give you an example. Professional traders always use higher time frame analysis to clearly identify market structure first before taking any trade direction bias. We can just see by the two charts we have just drawn. This is the 5-minute chart and this is the 4-hour chart. Look how different they are, right? If I simply mark the 5-minute chart, that huge big move with a highlighter, as you can see, is just a speckle compared to the 4-hour time frame, right? So the 5-minute bias is literally a teardrop compared to the river. That's why I keep the analogy going. So institutions look at the higher time frames because it's far more reliable and gives a far better signal. Okay, now let me show you a crystal clear example on the 15-minute time frame. So most retail traders would think it's a nice downtrend. We want to, sell off the trade, and it makes sense. Even though it's making new highs, maybe you would expect something over here. Look at this consolidation, maybe a drop towards the downside, whatever, They may even have a moving average plotted 50 MA, maybe it's gonna drop down after it touches. However, with trading, everything you put on can be fucking useless without the right context. You always want to trade with the institution, not against them. If you trade against them, you are liquidity, you will get fucked over. So what can we do? We can have a look at the higher time frame bias first. So let's take a look at the weekly time frame. Take a look at this. Does this look like a downtrend to you? Yes, we have two candlesticks over here going down. But is this actually a downtrend? Come on. It's going towards the upside. So the overall market bias at the moment is definitely bullish, and we are currently approaching an area of demand zone, right? We previously had this level over here, which is a rally-based rally, nice demand zone. Likely there's going to be a lot of buying pressure over here. So this is our higher time frame demand area. Now we can do the same thing on the daily time frame. Take a look. Over here, we had this nice little area zone. It's not as fresh as the weekly because it has been touched a few times, but the touch was kind of far away. It hasn't filled all the remaining daily orders and currently is sitting around this area zone, right? So I'm expecting that there might be a strong push towards the upside because it's a demand zone inside the demand zone. Big brother, small brother context. Weekly demand, daily demand. But for most retail traders like us, this is going to be a problem if we wanted to trade the weekly or the daily time frame because our stop loss would be fucking massive, right? So what can we do is kind of reverse engineer everything. We have to go to the 4-hour time frame and see what the hell's going on over here. And what can we see? Another area of demand zone just over here, which was never touched, by the way, which means it's a fresh area zone, and it's currently sitting inside the daily demand zone. So we have the weekly, daily, and the 4-hour demand area zone over here. So what this tells me that even if I look at the 15-minute time frame and look for nice little structure of some sort, I could potentially find a nice profitable, little day trade, scalp trade, whatever. And this structure over here tells me that it could be reacting right now. So if I enter this trading position, maybe a long just over here, stop loss just below the demand area zones, the rectangles, and target profit 1 to 2 risk to reward. Something like this would do. Let's place a trade, target our profit, and let's just see what actually happens. And look at this. Boom. It hits our take profit literally within a few hours time. 2 to 3 hours trading, you made around $1,000 immediately because you knew where the institutions were going to react. You didn't just trust the 5-minute, trend, the moving averages. They can lie to you because the context is different. The institutions are not trading there. So why would you? And let's just see what actually happens later on. Look at this. It continues going up and pushes the market further up. We can even go to the 4-hour time frame. Look, it retested this area zone once again. Went towards the upside on the 4-hour time frame. This is the daily time frame. Look. And this is the weekly time frame. Look at this. It never broke out the weekly demand area zone that we have marked. Just over here. It retested it. Yes, it wicked out a little bit because there were shorter time frame demand area zones that got filled, and then boom, pushed the market further up. And if you actually understood what the hell's going on, you could have taken many scalp trades every single time. Look at this, 1,000 pips profit potentially on the 15-minute time frame, because every single time the market pulls back, it's in the demands area, weekly demand, daily, 4-hour, it could be pushing up, pulls back, push up, pulls back, push up, you get it. And this is how you actually could be using the moving averages and etc. to actually see the pullback. Oh, it's on the moving average. I know the demand is in my area zone. I know where the market is likely gonna go next. And boom, you actually start making money. And look what's happening over here. Rally, base, drop. Right? Institutional pressure on the weekly time frame. So if we just simply mark this trade, look, rectangle top from the body over here, I expect a lot of selling orders in this area zone. This is where likely I can pretty much guarantee that there's going to be a lot of selling orders here on the weekly time frame. Let's just take a look. Actually, I'm curious. And look at this. Boom, boom, boom. Never broke this zone. Boom, dip down. This is where on the lower time frames, once you see this happening, you start selling the fucking pair and start making money this way. This is the only and most profitable way to actually trade Forex. This is how you pass your FTMO challenge. This is how you fucking pass your mom's challenge. I don't fucking know, but you can do it. This is the way you fucking trade. All right, so the trading method I just showed you is absolutely legit, but I'll be real with you. It requires a lot of patience and a clear focus on quality over quantity mindset. Trust me, if you're one of those scalpers who thrives on the thrill of placing a trade, it's not healthy long term. You absolutely need to develop discipline, so you can prioritize clarity that the higher time frames give you, despite the lower time frame temptation. And listen, I get it. I've been there too. First time I started trading, I was scalping every single time before I switched to swing trading. I actually love scalping the markets every single day, and especially if the trade pops off, instant gratification. But the reality is not every day is going to be profitable. It's going to piss you off. You're going to have moody swings. You're going to shout at your wife if you have one for no fucking reason, because you're pissed off that something happened that you have no control of. So it's never healthy, never good. So please listen and approach the markets with higher time frame context. You'll thank me later. So that's my little rant. That's it for today's trading lesson. Comment down below if there's a topic you'd like me to discuss next. And if you want to join my trading group, link down in the description below. 7 days free trial. And take care, Lions. Have a wonderful day. Stay safe and goodbye.